So remember, it's not that hard to raise your rent then by 3%. If it's only $30.
Yeah.
But if you got $200 a month cash flow year one, what do you believe year two should have with a $30 a month increase?
Plus 30.
Plus 30.
Yeah.
You guys, I can
360, right?
Yeah. So it's basically $30 a month, right? So you got 230 from 200. Well, when you do the numbers on that, I'm not going to make you guys do this, and we might have a longer pause with dead air. When you figure
15.
Check him out. He's already got it. So 15% compound growth in your cash flow. That's huge.
Welcome to the Infinite Wealth Podcast. I'm Cameron Christensen, along with my co-host Anthony Faso. We just wrapped up our interview with Aaron Chapman with Security National Mortgage. We've had Aaron on here a few times before. He is our first 3-time repeat customer, but man, he always comes with so much more information. We love having him back.
Well, and the reason why we had him on is because Fannie Mae had just made some changes on their lending practices for investors and people who own a second home. So he's going to go into detail of what some of these changes are going to be. And we also asked him the question, and I'm sure some of you guys might be concerned about this. I know I am. I'm about to close on a property here. And then I'm thinking, well, man, interest rates are going up. This foreclosure moratorium is about to expire. Like, the housing market has gone up. I mean, should I still move forward with it? And so not only does he answer it, but he answers it very thoroughly.
Absolutely. And if you guys are listening to this, I'm going to direct you guys to YouTube. Rarely do we send our listeners to YouTube, but in the second half of this, we're actually going to break it up into 2 parts. The second part is Aaron's going to share his screen, and he's going to dive into some numbers. And so if you guys are listening, do your best, but make sure you go to YouTube, subscribe to our channel. And what he's going to be talking about in the second part is he's going to be talking about a 15-year mortgage versus a 30-year mortgage, which we've talked about that, and he's mentioned it before. But Anthony, would you agree that this time there was just so much more information that he added in terms of inflation and how that plays into rates and cash flow and those things?
Yeah, because we've done our comparison between 15 and 30, but what we hadn't taken into account was inflation, which to me, that was eye-opening.
He called it an inflation-adjusted payment, and if you guys have not listened to it or heard that before, make sure you listen to part number 2.
And what I would not only is Aaron full of wisdom, but he also understands and practices infinite banking himself, which is why we like to use him for, if you're looking to buy a house for an investment purposes, that's his niche, investment. And also he understands IBC. So when you have that policy loan coming in, there's never that other question or that difficulty of proof of where the money come from. He fully understands it. So he's a great person to add to your team.
Yeah, great resource. Hope you guys enjoy this episode. I think it was early mid-March, right? Fannie Mae came out and made an announcement. They are tightening their standards on investment properties. Aaron, we're looking for you for some guidance on what that means and how that may affect or has affected investors so far.
Well, part of, I think the answer has to go with how did that happen and why did it happen? So you've got the U.S. Treasury made a mandate and renegotiated the contract with Fannie and Freddie and said, you are now going to limit your exposure on investors in second homes to 7% of their portfolio. So that means 93% of the loans that they back and insure, if you will, it has to be for owner occupied. Now, up to this point, as I understand, I don't have the exact numbers from Fannie or Freddie. I haven't personally given it to me. I'm just getting it from third parties that are tied to our company that do all the negotiations with them. They were saying there's somewhere in the range of about 15+% just investment property. Then you go and add second home into that. I'm guessing we're bridging over 20% for Fannie and Freddie. Now they're telling them you got to take it down, dial it back to 7%. That's huge. That's a significant amount. We're doing more than cutting their exposure in half. So what does that mean? Or one, how did they have the power to do that? Many people are asking, how did the U.S. Treasury tell them this? Why would they just do that? And then one, do it with no notice to the market. Just say one day, bam, it's this way. And it's not just this way going forward. It's we're going back to January 1 of 2021, and we're going to take your average from that point. Well, shit, we're already at
Dang.
30% as a company. So, and that's industry wide. I have a lot of people that I know I talk to in the industry. They're all highlight that. So, what is that? How did they do that? Well, look back the last 12 months. It's interesting how that happened the first part of March. What was the first part? What happened in the first part of March back in 2020?
COVID.
COVID and the shutdown.
Yeah.
It was the 9th of March that we started seeing massive movement in the market. What that was is because of that, we had a huge impact in the stock market, right?
Yep.
Stock pretty much crashed, as much as we can call it a crash, on the 9th. And then what happened from there is we started seeing interest rates spiking, going up and up and up and up every day. And I was trying to understand what was causing that. And I did enough digging and enough questions to the right people. I found out that all the banks out there that were housing people's money, when you go to a bank and you put your money into an account, they don't just stick it in the vault and it just automatically grows, right? They can't pay you, even though their interest they're paying us right now is an insult. It's not interest. They got to grow that capital somehow, so they lend it out. And they lend it on margin. Well, they also put it into the market. When they put that money into the market, they put it out there on margin. Then margin calls came in a big way to everybody in the banking industry. So how do they pay those margin calls? They don't pay it with fictitious money in the vaults because they don't have it. They had to start selling assets. Some of those assets were long-term notes and basically treasuries and mortgage-backed securities, which were a long-term bond. So they sell those assets to pay the margin calls. Plus, there's more to it than just that. But that was one of the main reasons that we saw that decline. Well, then you get to March 20th of 2020. We saw it had virtually just dropped off. Well, that's when the Federal Reserve comes in. They start putting money into the mortgage-backed securities pools. Between March 20th and March 30th, they put in $1 trillion to get it back on track. That's how much it took just to get the rates back where they were at previously. Now, what happened is we didn't see the rates move very, very quickly to mirror what they were before, because you had to have the market still had to kind of adjust and wrap their head around what was happening. So you didn't start seeing the rates come back for at least another probably 30 to 45 days after that move. And then, Fed kept putting in anywhere from $4 to $10 billion a day into the mortgage-backed securities pools to maintain those rates and keep them where we were. And then, of course, you see the news coming out. The Fed says, we're going to keep it this way till 2023. So everybody's of the belief rates are going to stay that same area, right? We might see a little bit of fluctuation here and there, which actually got kind of interesting how borrowers got really, they were trepidatious about locking the loans. Like, well, do you think it'll go down another 1/8%? It was already like 3.5. Yeah. Who gives about 3.375, right? But that's what happens when you're spoiled, right? And it's like, you watch a kid with 2 scoops of ice cream, they want that third scoop or at least another spoonful. It's the same thing. So you start seeing that this money became more and more available, trillions of dollars going into the mortgage-backed securities pools.
Aaron, could you help explain to Cameron, where's that money coming from? They got that they're putting in, like, where's the money coming from?
Yeah, that's the U.S. Treasury just creating it out of thin air, right?
Printing money, right?
Dollar printing money. Okay. Well, in reality, they don't have to even turn on the presses anymore. Just put a couple, click a little bit in the computer, create the money, hand it over to the Fed. The Fed goes and invests it into the mortgage-backed securities pools. So in reality, the U.S. Treasury owns all these notes through the Fed. Well, at least they own all these mortgage-backed securities that go to fund mortgages. They end up being notes. So therefore, they own the paper on all these houses across the United States. Now, it's interesting how that started back then. And I kept talking about how the Fed's going to keep rates low. And I've mentioned many times, about twice a week, I send out an update to my database on what's going on in the market. And I've asked myself and everybody a couple of times, like, what is the end result going to be here? What are they up to? Why would they put trillions of dollars into the mortgage-backed securities to keep the rates down? Sure, we're getting awesome rates and take advantage of it, but something doesn't smell right. Well, exactly 1 year later, what do we got? We got a mandate that comes out from the U.S. Treasury because they own all the paper. It's their money sitting there, our money, if you will, but they're the ones that are dictating what to do with it. And they're now telling Fannie and Freddie, you now have to do this because it's all our money you're using. So now here's what you got to do. Now, there's a couple of reasons why I think they're doing it. I've sat with a lot of people. I've talked to a lot of people. I spent a lot of time on the phone. I've flown up to corporate. I've talked with the guys up there. And what I had discovered is a couple of things. One, I believe they're going to create some other type of loan, potentially a lower document kind of a loan for low income housing. I can't be certain of exactly what the parameters are that going to be, but I think it might be some sort of an easier qualifying document on this deal. So there's that. And then the other is there's belief, at least what I'm being told, that there's additional risk because we're coming into a point where a lot of these programs and a lot of this government sponsored, I guess, economic injection that they're doing, whether it be paying out tax benefits, or there's the stimulus, or any of those things, is going to stop somewhere later this year. Well, when that does, what happens to people who are using that to pay their mortgages? And then there's the time when I think it's going to run out where they've given people clemency on paying their mortgages. Yep. When that does, what do we got? We're going to start seeing problems. We're going to start seeing a lot of potential foreclosure. Now, when you go all the way back to 2008, start looking in that area, you start realizing that a lot of the problems that were created, at least as far as the foreclosures is concerned, where people had 3, 4, 5 houses, no renters in them, right? They were just buying houses because they're going up in value overnight. They can flip them to somebody else and keep making this gain. And then when the music stopped, they lost everything. Well, I can see the point if we were still doing that kind of thing, but that's not how the real estate investors are operating today. So I think that there may be, and I may be wrong. Maybe they know more about everything than I do. I think they may be looking at it from the wrong angle. Think that we could have a repeat of 2008 with the real estate investor, when the real estate investor is different today from the real estate speculator of 2008 and before. So that in a nutshell is what got us to where we are today. Now the big question is going forward is like, what are we going to have next, right? What's going to happen? Well, what's going to happen going forward, my belief is it's not going to be much different than what we have for the jumbo loans. You'll notice we still have a lot of people buying houses in California, a lot of people buying houses in New York and other high-priced areas that can't be under that Fannie Mae limit. They got to be well over that, and they're still getting funded. So there's sources of funds for this, and there's these long-term bonds for these. So we're just finding other sources that are willing to do that on smaller loan amounts for real estate investors, and in my opinion, are a much safer bet for a person putting up capital.
Could you explain the difference between a jumbo loan and, I know there's a dollar amount that's different, but also how is that different as far as the loan itself?
So what I'm going to have to do is I'm going to have to Google conforming loan limit for 2021, because it's so rare that I do anything that's got any, even gets close to the jumbo market, right? So I got to look that up. It's 548,250 is the conforming loan limit. So anything with a loan amount above $548,250 nationally, where it used to be 510,400 last year, they raised it 7.42% to get to now 548,250. So that's the first step. You got that loan amount. And then second, you got your characteristics of it, where they're going to look at it a little bit differently, have different guidelines as far as what's the minimum credit score they're going to work with. They're going to have a different calculations when it comes to using certain types of income. Let's say real estate investment income. When you're talking about Fannie and Freddie, they would allow you, if you had a primary housing expense, just to use the lease on a property to offset the debt of the new property you're buying. Therefore, you wouldn't have an impact to your debt to income ratio, because you can conceivably see that somebody else will be paying the note because you have a renter. Now, with your jumbo loans, they're going to require that you have a 2-year history of owning that, and they want to take a look at the financials on it based upon what your Schedule E is going to show on your tax return before they'll count any of those rents to offset the expense.
Okay.
So those are a couple of the things. The other might be they're going to require more reserves, have to have you more money in the bank to offset the potentially cover any expenses, and then your debt to income ratio is probably going to be significantly lower in the jumbo world.
So when they're looking at reserves, meaning that they want to make sure you have some liquid assets to to pay. You have access. How do they look the cash value inside a policy loan, inside a policy?
Far as I can tell, they go dollar for dollar on that.
Okay.
That's what I have seen so far. I don't know if they have a different calculation line, just because it's so rare that I'm doing a jumbo loan. Typically, I'm
Okay.
doing a client of mine pulling cash out to buy more investment properties. But it's
Okay.
very rare that I have both of those two converging, right? Not only jumbo loan, but then jumbo loan with the cash value life insurance policy to
Okay.
remember how exactly they look at that. But I would imagine it's a dollar for dollar look. Now, if they're talking about like a 401k or an IRA or a stock fund, they're going to look at that at a percentage, like 60% or something to that effect, because the market can influence where it's going to go.
Gotcha.
And right now, everybody's worried about where the market's going to go.
Are you having conversations with investors about rates? I mean, they like you mentioned earlier, is people were trying to hit the rock bottom. Now that we're starting to creep up, is what kind of conversations are we having with investors as far as maybe they're concerned that they're going up?
Well, I'm constantly having that conversation with folks that they are going up, and it's not something that we're going to be able to avoid. Rates are jumping on us, and especially right now when you're talking about there's no government sanctioned source, if you will, or a government sponsored entity to go to. So when you think about that, when you're limited on where you can go, think the cost goes up. The other thing of it is those who are putting the capital up for this, they're willing to take these loans on. They don't know how risky it might be. All they can see is that the U.S. Treasury deems it risky. Fannie Mae and Freddie Mac are deeming it risky. So what are we taking on?
Mm-hmm.
Right? So we are going to bump the rates up. They already did. Right? So we were doing interest rates somewhere in the range of about 3.6% prior to this all happening. 3.5, 3.6 was pretty commonplace. Mm-hmm. Now we're talking about interest rates for 20% down in the high fours. So about a 1% jump, maybe 1.25. So to me, that's not bad. A year ago, right when COVID had hit, if I could give people an interest rate in the fours, they would have made a mosaic of me and put it in their child's bedroom, right? But because interest rates have pushed close to 6 at that point. It's just a matter of what we've been getting used to. People got used to those threes and thinking, and they're also the belief it was going to continue for a while because that's what the Fed was saying. And then we get yanked out from underneath them. And we had a bunch of loans we had that were not locked. But people were like, why didn't you lock me before that? Well, how would I have known?
Yeah.
Right. We don't lock it until we have an appraisal coming. And sometimes we lock too early because people told us that the house would be done or the rehab would be done or the construction would be done. And it wasn't done. We couldn't keep that lock alive at that expense. So people got hit a little bit. It's the unfortunate side of it. But when you think about what rates we have, they're ridiculous. In the fours is still amazing. When I got in the industry, I didn't get really, really busy till it dropped below 7%. They were in the 8s and 9s when I got in this industry. And that was for owner occupied.
Yeah, I think that's one thing, Pete, just like you'd mentioned with the spoiled kid. Like we expect these interest rates to be 5 and below. And historically, you look through time, like I was talking to my father-in-law, and he had a house at one point at 12%, or it may have been 20, and then the CD was paying 12. But in the 70s, interest rates were really high.
Yeah.
But I remember
the movie The Big Short.
Oh yeah,
mm-hmm.
Yeah.
Where they created the mortgage-backed security is created because interest rates were so damn high. A guy in the bond market could issue this bond for housing at interest rates in the high teens, low 20s. And then, of course, they're going to be able to take that and pay a ridiculous return to whoever bought into that bond, but they get to keep a pretty substantial piece for themselves. The bond market was making stupid amounts of money. As the character put it in there, he says it was nothing but a frickin' snooze. This is what he talked about the bond traders until that came along. All of a sudden, bond became sexy when Lou Ranieri figured out the mortgage-backed security and taking that off the hands of the local banks. The second they did that, it changed the dynamics of the bond world forever.
Okay, so what I'm hearing that with Fannie Mae making this change, and you're saying that they have about maybe 20% of their assets on the books, investment in second homes, and they need to lower it to 7. So what are they going to do to get it below 7? I'm assuming not issue anything, or
For right now, they're not going to buy anything but owner occupied for the time being.
Okay. Okay. So what does that mean? Because I would tell you, I'm about to close on a property here shortly. Um, Hopefully by the end of May or, but so how does it relate to an investor right now who's about to close if they can't use Fannie Mae?
Well, I mean, it's just we can still do it the same way. It's going to feel very similar just
Okay.
to how we do the loan, but the interest rate's going to be in the fours.
Okay. So what I'm hearing is interest rates may be a little higher. It might be a little harder to qualify as far as,
You're going to
uh,
probably have a higher credit score requirement because we're not going to. We used to be able to go into the sixes, kind
mhm.
of deep into the sixes. Now, not so much. The loan amounts, as far as the lower loan sizes, are not going to be as available. Like anything below, I think it was like $65,000 is going to get harder to get funded because of cost to loan size ratio regulations for lower income housing. What's funny is all the lower income housing um, rules that we've been forced to live by seem to also overlay the real estate investor who's not a low income housing recipient, right? They're creating the housing, but yet they can't be charged certain percentages above what their loan amount is, um, which I guess is good for them, but ultimately it stops their ability to get funded on some of these lower purchase prices.
Okay. So the funding's still going to be there. It just may be a little harder to qualify and the interest might be a little higher.
Correct. That, and it's just harder for us because we're having to scramble and find different places to park it. Right. I think that last I looked, I was like also in the range of about 5% of our company's total volume. And we're trying to keep it under 7. And I only do real estate investments. You can imagine what they're scratching their heads trying to figure out right now.
Okay.
Plus,
So,
it's freaking me out because I got to get my shit funded.
okay. So it just, as we were saying earlier, okay. So interest rates are going to go higher. And what do you say to the person's like, wait a minute, I was going to buy this house, but I was expecting, you know, a 3.5, but now it's 5. And there's probably some people that are getting maybe um, a little concerned or maybe backing out. What would you tell them?
So that's where I'd like to get into toward the real value of real estate is. Help kind of educate them a little bit more on this, and that it's not about the interest rates. Especially like the real estate investor. There's real estate investors, and then there's opportunivores, right? There's people that are getting into it right now because interest rates are so low. Great opportunity, right? But they're not in it because they understand real estate investing as a whole. So this is where the great separator becomes. In when I say real estate investors, you're going to double down and keep getting into it because the people that don't understand it well enough to think that now is not a good time because rates went up. They're going to get out of line, and you're going to be able to go a little bit further into line. It's no different than waiting at a restaurant. And you see the waits at a half hour. You're like, I budgeted for an hour. I'm good. Well, 10 people in front of you, like, I only budgeted for 10 minutes. This is bullshit. I can go through a drive-through right now. Well, they leave, and you get to you're in now 10 minutes, right? Because you're the ones that budgeted better than the average person because we're all impatient some bitches. Well, the same thing with these opportunivores, if you will. They get in line because great opportunity, in their opinion, is low interest rate. They fail to realize that the 30-year fixed mortgage is where the great opportunity is. Somebody being willing to leverage that for you for the next 30 years is where huge value is. So I've got, and I have, in fact, it's even set right now at a 5% interest rate. I've got a tool here I can share. Let me change the date on it just so people don't get confused with the date. And I will share screen with you guys so we can talk about this.
Perfect.
So what I have here is a calculator that goes over a 5% loan, $100,000 purchase price with $80,000 loan size over for a 30-year window with 12 payments per year. So we're seeing right here the principal and interest payment is $429.46. Interestingly enough, the first year you're paying under $100 or right around $100 in interest. So you can see that the interest is very, very actually paying more interest than principal. Ton of interest in the first 5 years, very, very little principal. So we'll go ahead and advance this all the way down to 30 years. I'm going to advance it a little bit fast. So 360 payments later, you'll have a total of $74,604 in total interest paid on this $80,000 loan of 5%. So you add those two together, you get $154,604.63 principal and interest over 30 years. So many folks are thinking, wow, that's a lot of money that I'm paying over that 30-year window. I want to get that paid off faster, or maybe it's not worth it to me. Well, when you look at, and you let's change this back to 3.625, just so we have the differential here, so we can see the difference between the 74,000 interest and the 51,000 interest. I can see that's a pretty substantial amount, right? That's $23,000. Basically, you're seeing different here over 30 years.
Aaron, if I could just explain for the people who are listening to this on the podcast, that the total interest now, when he lowered it, instead of being, was it 75,000? It's now at 47,000.
That was not correct. I fat fingered that one because I had changed it. So 51,342.77.
Okay, perfect. Okay, go ahead.
So that puts us, we're a total of 131,342 principal and interest over 30 years. So I can see the difference there. Now, when you start getting into what is inflation doing to the U.S. dollar, I always ask, everybody, what is your estimation of what the U.S. dollar is doing between now and 30 years?
10% plus.
I could see some hyperinflation. Let's say 6 or 7 to be. I think it could be like
a little bit more conservative.
Yeah, more conservative. They usually tell us it's around 3 to 4, something like that. But
we know they're jerking us off because they're only utilizing things that they can control with monetary policy.
Yeah,
with CPI and the PCE, we're not looking at the actual cost of food and energy and most of the segments of housing. They're definitely not factoring in taxes, right? So
no.
Add all that in, the U.S. dollar spreads less and less and less every year. So let's go with the more conservative number of 7% inflation. So I plug that in right here. That means the U.S. dollar, on an average, in our estimation, based upon how we spend our money, which is a little bit more discerning than your average human being, we're going to see potentially it's spreading 7% less every year. Now, it's interesting. It never goes to zero. It never vaporizes. It just, everything costs more. So when you factor that in over 30 years, even though 5% interest created 74,000 in actual dollars being paid out in interest for a total of 154,604 to borrow 80,000 for 30 years. But when you consider the fact you're repaying it with a declining instrument like the US dollar, and you add all those up, you start to find that the value of that $429 payment, $429.46 is what you're paying every month at 5%, is actually over the very last payment is equivalent to $52.91. That's the value of the dollars at that time. So $429 today is equal to the cost of a latte 360 months from now, basically.
It's crazy.
When you add them all together over the entire 30 years, the actual value of all those payments over 30 years, when you recalculate that based upon inflation, is $64,550. You did not even pay what you borrowed back. So the easiest way to remember this is if the real rate of inflation is 7 to 10%, as long as the interest rate is below that number, you're paying less than what you borrowed. They're literally paying you to have the house. And what's really, really cool about this is we get to raise rents because of inflation, correct?
Yeah.
Yes.
What would you say is a reasonable number to be able to raise your rents by?
3.
What was that?
Around 3%?
Around 3%. So in this example, we got a $100,000 property, and let's just say you're renting it for, I'm going to bump this up for sake of numbers, $1,000 a month. And then you get to raise rents by 3%. Your total rental income continues to go up every year as a result of this, because your rent starts to adjust from year one. Let me see if I can find year one here. $1,000 on year one, you start to see. Then year two, it goes up. Why is it not factoring in 3%? Well, it's factoring in 2% for some reason.
Okay. Oh, I see what you got.
2%. 2% the next year, even at 2%, you go from $1,000 a month. You're going to see let's see here. Well, they're adjusting this calculator is adjusting it for inflation. So this is not going to tell me what I want to show. So I'm going to go ahead and exit the screen share so we can just talk about it directly. So if we were talking 3%, like we just mentioned before, I did not try to use my damn calculator, which sometimes I don't. So it was built by somebody a hell of a lot smarter than me. The professor of accounting at Kennesaw State University is kind of a partner of mine in this.
Sounds brilliant.
And he's awesome. And he's a real estate investor and a client. So he's wrapping his head around all this stuff for me. He says, I will build it. You just go out there and shake your ass and show people how to use it.
I like the guy. So
he's a hell of a guy. Ultimately, if they're raising it 3%, you got $100,000 property ready for $1,000 a month. So let's say year one, you're renting it for $1,000. You're getting $200 a month in cash flow. Is that an unfathomable scenario to get $200 a month cash flow on $1,000 a month rent when we got a $429 payment?
I don't know. It's reasonable.
Yeah,
seems really reasonable. So, and that's a principal and interest payment, by the way. You still have to get your tax and insurance there.
Yeah.
Now, year two, you raise it by 3%. So, what is 3% of 1,000?
30.
$30, right? And I say it takes a little bit for people. People want to say 300 all the time. So you fought that one really well.
And so my podcast, I'm like, I really don't want to screw this up.
I wanted to say 300. I'm not gonna lie.
Everybody does the 300 thing, and then they get disappointed when it's only 30. It's like, crap, it's only 30. I'm like, don't get disappointed. Only 30 is kind of cool to think, oh crap, I'm only getting $30. So remember, it's not that hard to raise your rent then by 3% if it's only $30.
Yeah.
But if you got $200 a month cash flow year one, what do you believe year two should have with a $30 a month increase?
Plus 30.
Plus 30.
Yeah.
You guys, I can
360, right?
Yeah.
So it's basically $30 a month, right? So you got 230 from 200. Well, when you do the numbers on that, I'm not going to make you guys do this, and we might have a longer pause with dead air. When you figure
15.
Check him out. He's already got it. So 15% compound growth in your cash flow. That's huge. You're getting a compound decline in the instrument you're paying it back with at 7%, but a compound growth of 15% in the cash flow that you're making. That's a massive arbitrage. That's more than double the difference.
So that's that was awesome, Aaron. I just wanted to make sure Cameron understood, right? So we started with 200 cash flow. And that $30 increase, now that's a 15% increase from the 200.
Correct.
Right?
15% compound growth in your 200.
Exactly. Plus, we paid a little bit of principal down on the loan, right?
Maybe it's under $1,000.
Or let's just even say, under. Okay, but then we also appreciated on $100,000, right? That value is, instead of the house being 100, I don't know if we're using 2 or 3 now, but now we've compounded on the 100, right?
Yeah. And the thing is, even if we don't compound on the 100, even if there's not even any appreciation, if you're in a linear market, you just see what just happened there with the cash flow versus what you're paying for it. You're literally paying back the person you borrowed it from less than what you borrowed, but you get to then have this compound increase in what your cash flow becomes. And then, in year 3, you're not just getting the same $30. Year 3 is 3% of the new 1,030, right? It may be only 1,030, and I had this written down at one point. I've kind of written all over it now, but it may only go up like 9 cents or something like that. But you start to see the compound growth over time. And within about a 3-year window, those increases in your cash flow will then overshadow what you thought you would have been getting with that 3.625 interest rate. It doesn't take long, a couple of years to go by with you buying a property. And this is what I tell all my clients. You're the CEO of your real estate investment firm. If you did the job right, which you're going to buy with the right people in the right area, a particular property, which is one small business that you can continue to raise rents on, that you believe will stay reasonably rented the time you own it. If you can do that job right, within a couple of years, it doesn't matter what the interest rate is, you've already passed it. And then, of course, every time you raise rents, that 3%, you get that compound growth, and then that compound decline that continues to separate so quickly that it's not going to matter 3, 4, 5, 10 years from now. Think about what 30 years from now feels like. For you, it's awesome. Whoever you borrow the money from,
Yeah.
whoever really sat down and did the numbers, they're pissed. But a lot of people will say is if that's the truth, and that's what's happening, why is the banking industry willing to allow us to have 30-year fixed loans if they're truly losing money like that?
In order to hear the answer to that question, you're going to have to check out part 2 of our interview with Aaron Chapman, which should drop in 2 weeks. Now go make it a fantastic day.